Hi, class. This is chapter 3, week 3. Mm, And let's start right away. Okay, here we go. And voila. So, in chapter 3, we're going to talk about measuring the economy, GDP, and economic growth, GNP, and how it's done. Now, the learning objective is to describe the circular flow of national income, explain the concept of equilibrium and why national income can rise and fall, describe the component of GDP, and understand some of the problem in determining the official statistics. Also, we will be measuring and describing the benefit of economics growth, explain the importance of productivity in encouraging the growth, and some of the problem of unchecked growth. So there is a circle of flow you need to keep in mind is to consider a simplified economy of two. Every economy is made of business and household. And business sell goods and services to household. So and in return, household provide factor of production to the business. So when a business sells goods, makes goods and services, sells to household will there is a consumption spending. So the household will buy things and pay money to this. And there is the factor of productions, which is when they produce, these people working here, and then they are paying to the household in the rent, in wages, interest, and profit. So this circle keeps going on. Now, consumption is a household spending on goods and services. So the consumption is the household spending on goods and services. Product market is market for consumers, good and services, and the factor market factor or factor market, the market for the factors of productions causing the production. Now, the circle of flow of income, as we said, is basically is this part is a product market. So the business will produce product and services and gets money, spending money, which is the household is consumption due to the consumption is needs to spend money on businesses. On the second hand, which is called a factor market, which is once the household gets the salary, rent, interest, profit to the household is a factor of production, help in the production. So the national income is basically sum of all the spending or sum of all income earned. This all income earned or sum of all the spending. Now, stock of money is quantity of money at a specific point in time. And money, the way it looks at it, some people look at it as a commodity, and some of them looks at the tool of the trading. But money is also considered to be a commodity, which is high and rise in it, in something like that. So stock of money, quantity of money at a specific point, and the flow of income is the amount of income over giving period of time. So it's a 1 year, 1 month is 1 week is a flow of income. Now, velocity of money. This is another term that you need to know. Each time money from a stock is spent. When you are doing a saving, it's a stock of money. As each time the money spent from the stock, it added to the flow of income inside the spending and all these things. And the number of the times it is spent in a year on a final good is called a velocity of money. So how quickly is this money when it comes to the business pays it as a rent or buy things and this moves again to the hand of household. And this circulation is called the velocity of money. So the total income over money supply. And saving and investment. The portion of income that is not spent on consumption, it's saving. It's important source of loanable funds because you save, then you put it in there to loan it for order for the investment. And the amount is depends primarily on the level of the income. The more the level of the income is higher, the lower the spending, the saving is higher. So the total income comes from consumption plus saving. Now, in the saving and investment, saving is kind of, they look at it as a leakage from the circulation, the consumption and spending out of that circulation. This leakage is any flow of income that diverted out of the circulation flow and doesn't flow directly back to it. So saving, when this circulation is happening and the saving comes in, and if you just assume you save it as a cash and under your pillow, that's leakage. But there is investment, which is investment means spending on a capital goods and represent an injection into the circulation. So when you're investing in a tractor for your farm, this is what you call investment. When you're building a store from bricks or whatever, that's called investment. So represent an injection into the circulation flow. An injection in any spending flow that is not depend on the current level income. So it is not it's not an injection is any spending flow that's not depend on the current flow of income, could be low, high, doesn't matter. Investment is autonomous, standalone, and it's not determined by income. It could be an investment from outside or somebody who is have lots of cash and moves it from one place to another place to invest in it. Now, the circulation of the flow income, as we said, is the household and the business. And the goods and services comes from business, and there is a factor of production goes to the business, and there is a rent, interest, and profit paid to the household in order to buy back. Now, so when we said the investment is autonomous, now when you do a saving is against the investment, and then when you do an invest, a household doesn't save because income minus the consumption, you have saving, and this saving you put it in the financial intermediaries like bank, insurance companies, which is they will do the investment into the business. Now, when we come to the import and export, and I'm going to add a few videos on the import and export, when a good and service are imported, Canadian payment go out to another country. So there is the imports are a leakage because the money goes out to other country. Now, when the goods and services are exported to outside, foreigner payments, money comes in inside into a country, which is export or an injection. The investment is reversed. We will talk about it later. So the circulation flow add foreigner sectors means the foreigner sectors, it will be is like if you are doing for the export, so the foreigner sector will inject money here. And if you are doing an import for the household to consume, you're paying the foreigner outside. So this is the independent circulation that outside from the household, and this is the financial inside investment. Outside investment, inside investment. Now, taxes and government spending. Government collect tax as usual from the household and businesses, which leak out of the circle flow of income. Now, the tax revenue may be used for the government spending programs, which is injection again. So when it leaks out, when they collect the taxes, and when the government puts the money spending, make buildings, as street infrastructures, this the government is injecting again the money. So once again, uh, we said that the household, when they consume the international product, is that they have to import it into the foreigner sectors. And the foreigner sector, if you're exporting to the foreigner, the payment goes into the business. And also for the financial intermediaries, if you are the household and you're saving from your income, so you put it in the bank, and bank will be investing in business. So in the case of the government is the fact that when they're collecting tax, they are, taking money inside the government. And when they're spending on the household or on the businesses, they are like doing roads and all these things on businesses that putting an injection of money inside. So leakages. Income received with a circular flow that does not flow directly back. So if the income received within the circular flow, that does not flow directly back. It could go straight to saving or could be tax less the transfer payment. So, and transfer payment is a one-way transaction where payment is made, but no good or service flow back, like imports. Let's say you have a debt, and the debt you have to make it payment. That could be a transfer payment, which is no good is coming in. You've already consumed it. Now, the injection, any spending flow that does not depend on the current level income. So investment in capital good, government spending, and export is an injection of money, injection in the economy. Now, so the leakage comes due to the saving, paying taxes, and importing. Injection is about is foreigner investment or local investment, government spending in Canada, inside the country, or the export to outside. So in the equilibrium, we at the state of balance, when there is an equilibrium, state of balance, no tendency to change. And if they are equal and we are at the equilibrium, now we could have import a lot, which is their money goes out, but there's somebody is investing inside your country, and that causes an equilibrium. The national income equilibrium is the level of income where the total leakage are equal to the total injection. Otherwise, you would go to a debt, and the debts probably convert if you keep going on. You might be more leakage, and so the always you want to make sure as a country your leakage is equal to the injection, or probably the injection is gets higher, but it's still you have to look at your Gary currency value, because if there is more injection, the currency goes high. Now, the total is S plus IM plus T, which is we mentioned these abbreviation, which is stands for saving plus import plus taxes equal with investment plus export plus government spending. Now, if the injection are greater than the leakage, the economy expands. So there is economy growth. If the leakage are greater than injection, then the economy contracts and gets smaller, which is called a recession. Now, the value of production. The value, which is another view of equilibrium, which is more doesn't takes into consideration production itself. So the value of production is equal the amount that the producers receive from the sales revenue, which is equal to the total spending by the buyers, aggregate spenders. So they are in the equilibrium situation. The buyers spend equal with the money received. As equal that the cost of the production include profit, which is equal to the total factor of income. So profit is part of the equal the cost of production. Now, in other words, means the value of production is equal with the sales revenue, how much you're selling, equal with aggregate total or aggregate expenditures. And so the cost of production, including the profit, is equal with the income. And so in the equilibrium, if the aggregate expenditures is equal the total income, and that's where the equilibrium happens. Now, to do that, to measure the national income, we need to look at the expenditure approach, which is the aggregate spending, or AE, consists of total expending. It's made of, as we said, consumptions, gross investment, which is comes from saving and then investment, government spending, and net export. So the aggregate expenditures is equal with consumption, gross investment, which is investment outside and investment inside, minus inside, and the net export, which is export minus import. Now, measuring the national income approach, alternatively, we can add up all the incomes to the three major sectors: the household, we said, the business, and the government. So these are the three sectors which is available. We can measure this income in the equilibrium. The total will be equal with the aggregate expenditures of household, business, and government. This is why sometimes you see the government increase the expenditure if the economy is slow, and once you see the business is booming, but there is a high inflation, the government will hold on the spending. Now, measuring national income, the mechanics way, is what you call the gross domestic product, which is the GDP. And we will be talking a lot about GDP, GNP, and GDI, which is GDP is the value of final goods and services produced in a certain period. On the other hand, gross domestic income is total earnings received by household, business, and government in a period. That means including the money from foreign investment. So GDP equal with income and equal with aggregated spenders. They all have to be equal with each other. So measuring the GDP, the expenditure method is usually Statistic Canada expenditure GDP is doing the spending on consumer goods and service. Calculate that. Whether it's durable, non-durable services, all the spending, plus or minus the investment, which is spending on capital goods, machineries, total constructions, roads, and all these things, plus the government spending, which is by all the level of government, how much they spend, and plus the net export, which is export minus import. So this is the expenditure method. And the net domestic product is basically when we have a depreciation, is depreciation is the value of existing capital good decrease over time. So you're consuming a car or something, the price goes down, depreciate. So the net investment is the total investment, which is the gross investment that you put in minus the depreciation of, of it. And the indirect taxes, the sales taxes that business collect for the government. So, for example, the value added taxes, the GST, the PST that we have here, when the government, when you go and buy a donut, the businesses collect taxes, and this is the value added taxes the business collect on behalf of government, and then they have to pay the government. And that's called indirect taxes. The direct taxes is when the government deduct from the profit, for example, or your income. So the net domestic product, or NDP, is the value of production after accounting for the depreciation and indirect cost. So the GDP minus the depreciation minus the indirect taxes is net domestic product. Product is how much the really is producing. We have something higher than the net domestic product, which is something net national product. So if a foreigner corporation operates in Canada, some of the profit may be transferred out of the country. Also, foreigners may be working in Canada while some Canadian may be working outside. So the net national product, or NNP, accounts for national domestic product plus the foreigner factor income, whether it's a positive or negative, is depend if the foreigner corporation work inside or local work outside. Now, let's. There are so many information that just presented with you. Now let's see if you able to grasp some of them. So what I want you to do is choose among the following to identify the element of the Canadian economy in case of a Canadian. A consumption, which is stand for C, investment I, government spending G, um, saving, which is stand for S, import IM, export X, T, taxes, and not applicable. So we need to choose among these statements which appropriate letter or word is the right one. So a student get a haircut from a self-employed hairdresser, somebody who is working there, a hairdresser. What would be in this case? So in this case is a consumption because a person is going there to cut his haircut. To this person is means consumption. Then the hairdresser gets money and he buys a scissors for cutting more hair. So in this case, mm, uh, he's doing an investment because this scissor he's going to use it for generating more businesses. Now, out of each day revenue, the hairdresser saves $5 into his piggy bank. It's not in his pillow. That means is saving, because he's taking it out of the money circulation. And when she can, the hairdresser buy General Motors share, which is this is not applicable to the elements here. So GM expand its computer facilities in its head of office. So here what he's doing an investment because he's bringing more computers for people to use it so they can produce better. And when the American tourist goes to skiing in Canada, comes to skiing in Canada, that means it's an export. Although the American is coming here, but he's bringing money and he's consuming for him. So it's called an export. When the two Canadians go to Tokyo, for example, and stays in a hotel, that is an import because the money goes out of the country and Canadians are consuming there. When Russia buy a beef from the cattle ranchers in Alberta, this is a very straightforward, which is a Canadian farm is selling to outside to Russia. Keep in mind, always focus in Canada when what's the situation is happening when Canada if somebody comes in or a product goes out or a Canadian goes out and spend there. This is how you look at it because when is an export, in this case, for example, Russia buys a beef from Alberta cattle ranches. If we're looking at the Canadian market, it's an export. But if you're looking at they are buying these, so Russians are importing, but the Canadian are exporting. Now, Saskatchewan pays to build a new highway. This is a government spending and a very clear one. Now, measuring GDP, the income method. The Statistic Canada income GDP include the compensation of employees, the gross operating surplus, if there is a surplus, the gross mixed income, we'll explain each one alone, and taxes, the net of subsidies on production, and the indirect taxes. So this is the measuring GDP, the income method, the way it's based on income method. And expenditure of GDP based on the income versus income GDPs. Here you can take a look at it and try to why a consumption is considered to be expenditure, why government spending, which is considered from the government point of view expenditures, and try to look at it the net export because the import is more than its export. Then so you have a minus 46, for example, and here, when you're balancing the expenditures versus the income, just like a balance sheet, you get the total equilibrium. Now, measuring the GDP, the income method, um, we said that the net domestic income, income after accounting for the depreciation and the indirect costs, so which is equal NDP. And we have something called net, which is national income, adjust the NDI, which is the national domestic income, for foreigner ownership, foreign workers, and Canadian working abroad, which is if somebody comes in here and they own a state or land or factory, they might be taking it out. So you need to look into this, take it into consideration. Or somebody from outside comes in here, work here, take the money out. That's also a foreigner workers and Canadians who was working abroad and taking money in. That's a positive thing for the national income. So the personal income is a person's gross income, a total income, how much you're spending, how much you're making income, how much is before spending, because this is a gross income, much you pay taxes. But the disposable income is the money that remain in your hand after you paying the taxes, and you can spend it on things. So it's called the net income that people take home after the income tax and other payroll deductions, which is household either save their disposable income or use it for consumption or save some and use the rest. Now, just to make you to understand, if a personal income is $986 per week, per 2 weeks, or whatever, and personal income taxes are 227, and the consumption is $686, what is the value of saving? The value of the saving is, as we said, the disposable income is equal with the personal income minus the taxes. So that's a disposable income, which is 725. Now, out of that, if you spending the consumption, the money for food and everything, it's remain monthly, for example, $73, which is that you're saving. Now, the problem in measuring GDP, we need to exclude the intermediate goods, the goods that, moving from one factory to another factory to be produced, to then to the third factory. These are the intermediate goods. The sales that merely transfer ownership is like you make a sales for a, but there is no ownership transfers in it. Public and private transfer payments, and secondhand goods, like goods that you really bought it and you're reselling it again. Um, the other problems with measuring GDPs, they're not including the underground activities like illegal activities like drug dealing and all these illegal stuff. And there is some unreported activity when you sell and you don't want to pay taxes, so you just collect cash. The other thing is non-market activities like you're working at home, service of homemakers. They do it yourself instead of bringing somebody to fix your windows. You do it yourself, and or you go and volunteer. This is part of income, but is not uh, included in the GDP. Now, when we have a real economic growth, economic growth is basically means an increase in the real GDP per capita or increase in an economic capacity to produce. So there is two way of looking at it. Once your growth increases per capita, and the another is when you increase in economy capacity to produce. So nominal GDP is the value of GDP in terms of the price prevailing at the time of measurement, but the real GDP is the value of the GDP measures in a term of prices prevailing against the base year. So the real growth, you nominal GDP is how much you make in 20,000, for example, this year. But the real GDP, when you compare it to the year before and the year before, something like that. Now, so the GDP per capita, we may also want to account for the sharing of the GDP among the populations. And the real GDP per capita, some of them is high, some of them is low. So you do the real GDP divided by the total population, and that's where you get the real GDP per capita. So the growth of real GDP per capita is the best measure of change in the standard of life. So the more you have a higher GDP, the better you have a standard of life. So let the real GDP be the real GDP per capita. Then it means that the growth, this is how it be calculated, is uh, current GDP minus a previous GDP, like a last year or 10 years ago, divided on previous GDP because you want to see the changes somehow, and multiply by by 100, and this is you do the calculation for the growth. You can, do some exercise on that, but it's a straightforward calculation. So why we need to have an economic growth? What's the benefit? Well, when economic growth happening is you have a better health service, means that you improve the quality and the length of education, better transport, more support for arts and culture, and better protection of the environment, and protection of human rights with the democratic involvement. These are the wonderful things that comes with the economic growth. The source of economic growth is when you talk about the labor productivity is the measure of the amount of output produced per unit in a labor input. So labor productivity is how much each unit, each labor produced. So the output in a certain period divided by units of labors. And a capital is accumulated skills and knowledge of a human being. This is a little bit difficult to calculate, but knowledge and skills is very important for productivities. Now, the source of economic growth is, as we said, quantity and quality of the labor's resources. Um, Amount of physical capital available, how much physical capital is there, the rate of technology, how speed is changes happen, the technology, because the more we said there is a shift in last class in the supply if there is a rate of technology keep changing, and the amount of the and quality of the natural resource. So if you find an oil or gas, there is a jump, as we see in Saskatchewan, for example. They found lots of oil, and there is a huge growth happening in Saskatchewan. Before that, it wasn't higher GDP isn't always better. Sometimes lower GDP can be more beneficial for the growth. Maybe the result of including the value of some services they were perceived excluded. So sometimes you have a growth GDP, but suddenly get it included. The quality and desirability of the good produced is ignored. So because your production is so much and you're increasing productions, it's just like happened in Soviet Union, the quality might be ignored and you say, oh, I'm producing more, so I have a real growth in my GDP. Now, the other thing that you might see, the per capita GDP will fall if the population growth exceed the growth of GDP. Sometimes maybe the GDP increases, but a gross national product per individual, the GDP per capita goes down because the population, there is a booming in population, but say the growth is of population 20%, and the GDP growth is only 10%. So that's also you need to take into consideration. And the social and environment of higher GDP sometimes is ignored. For example, you become a super high consumer and you start throwing plastic all over the place and you're not considering the recycling, and these things comes in with the higher GDP because higher GDP means more consumption. So here we come in the chapter, end of chapter 3, and concept that you need to remember is the circular flow of national income, how it is happening, the concept of equilibrium, and why national income can raise and fall, how to calculate various national accounting statistics. You just look at them. I showed you this. You just look at them. You don't need to do the calculation. And the measurement, important source, and problem of economic growth. Now, there is one thing I would like to share with you before we finish the chapter 3. I will be creating something is with a Padlet and weekly, and you need to go to that and enter your thoughts after you're looking at the chapter and the videos that I did. And this is what you call the class activities. So look forward for Padlet in the end of the in today presentation. Well, you have a nice day, and I'll see you next week. Let me know if you have any question. You can email to me, and I'll be glad to answer it. By the way, good work. Keep on the good work, and have a nice day.